thanks very much for joining us today. Today, we want to go through insurance. It's one of those things that I would say, love to hate. And you kind of want to have a situation where you're paying for insurance and you want to be in a situation, I think, that you get to the end of a certain period, 10 years, 20 years, whatever it is, and you actually haven't had to claim on it. And then you feel a bit frustrated because you think, well, that was the biggest waste of money. But the positive side of it is that you didn't actually have to claim on it. And so I guess what we wanted to go through today is insurance minus all of the bull that goes in it, making sure we're understanding the fine print, know what you're buying, and then also what to avoid. And I guess when I talk about the insurance and why this topic is really important, why I wanted to go through it with clients so that you kind of understand on the insurance aspect is we've had a number of claims, over the years here and there, more on income protection and trauma. But we did have our first, I guess you could say, life insurance for a young person, and young person saying, 46, because they're only a few years different to me. So of course they're young, but, a young person, kids in primary school, and mortgage and husband, and just going through that process with them on the insurance. Their world would be very different without that insurance today. They would have there'd been a whole world of additional financial pain in addition to the pain that they're going through now as a result of having the life insurance. They have been, and whilst this can't bring the mother back, obviously, but the life insurance did actually cover the home loan and also the school fees for the kids right through to year 12. So that is one stress that the father now can reduce their work hours to help look after the kids a bit more. So, going through that experience, actually, it's still quite raw for us at the moment. And going through that experience with a client really wanted us to kind of trigger again the insurance discussion, because as a firm, we've never been really the strong promoter, saying to people, yes, you need to get the highest possible insurance. But I think when you have things like this, it does really put things into perspective. So I'll start going then. Bianca, if we want to move on to the next slide. Thank you. Great. Just obviously everything today is general advice. It's not personal and tailored to your situation. So all of the fine print, but we can chat to you about your specific situation. Okay, thank you. So my name is, I think I've met most of people actually on today. I think there's only a few names that I'm not aware of, but so Shannon Smith, financial advisor and founder of Smart Business Solutions and Smart Private Wealth. With me today, who'll be leading most of the presentation, is Bianca Carroll. She is a fully licensed financial advisor and recently actually won the Emerging Advisor of the Year. So Bianca will take us through. She's got a big passion for insurance, especially after these claims recently. So we'll take you through a lot of those details of it. Now, what we want to cover, and I know that insurance is not the most exciting topic. Again, it's one of those things that we love to hate. It is just so important when you need it. So we want to talk about what are the different types of personal insurance, insurance cover at different life stages. You should be evolving with your insurance cover. How much insurance do you actually need? And then what is step versus level premiums? And I think that's a really important one for you to understand that. What insurance is tax deductible? What are some of the ins and outs of a bit on business insurance? And then how can we help you as advisors? So I'm going to hand you over to Bianca. Thank you.
Thank you, Shannon, for that smart introduction. We'd like to begin today with discussing ways that you can look after yourself, your family, and your assets if something were to happen to you and you were unable to work. So when you've created a comfortable lifestyle for yourself and your loved ones, it's definitely worth thinking about what would happen if you were unable to work for a while because of an illness or an injury or an accident. And how would you and your family cope financially, not only with the costs of the medical care, but also keeping up with regular expenses such as mortgage payments, bills, and also school fees. So insurance is a very important way of ensuring that your family and your business will always be looked after no matter what happens. It provides a financial safety net to support you and your loved ones if the unexpected does occur. So the way it works is like this, that you pay a premium on a regular basis and you or your beneficiaries receive a payout after an event like an illness, an accident, or even a death. So the money that you put into your insurance cover is working to protect the things that matter to you most. So your family, your health, your income, your business, and your lifestyle. And the purpose of insurance is to provide a level of financial protection for ourselves and for our families. So despite this, with so many insurance products being available, our research suggests that only 83% of Australian households, that 83% of Australian households are actually underinsured. So it's often coupled with perceptions of, insurance is too expensive, or I don't need it, or I'm covered by my super. So it's really good to have a look at the ins and outs of this and make sure that we are covered. So a common cause of underinsurance is the fact that many people settle for the insurances that are contained in their superannuation policies. And recent research shows us that the median level of life and income protection cover in Australia meets just 61% of our basic needs. So it is really important to read the fine print, including your PDS or product disclosure statement. But also, along with that PDS that you're given from your insurance provider, it's also important to read all of the other documents that your insurance provider gives to you to ensure that the insurance that you are implementing or that you currently have is the insurance product that you need. Some of the automatic insurance policies may decide not to pay you your insurance benefit at claim time, depending on the terms and conditions that they have, and also depending if you might have any pre-existing conditions. So it is a really great idea to find out if you have personal insurance held in your super, what the premiums are, and also what the insurance benefits are that you're covered for. So an insurance benefit is the amount that you're insured for, and some personal insurances can be held in super and can be unitised, which means that you may be automatically allocated an insurance benefit according to your age, your gender and your occupation. And some insurance benefits will automatically decrease with age as well, while the premiums increase with age. Some of the super providers that provide you with automatic insurance will also have an option, may have an option for you to increase your personal super benefits, and while others may not. So it's really good to get an idea of what you actually have. So the quality insurance providers will do their underwriting up front when you apply for the insurance and before they put your insurance policy into force. So underwriting, what is this? So that's where the insurance provider will ask you questions about your health and your family health history, and they'll then assess this as to whether they can make you an offer of insurance to cover you. And depending on your health and your family history, the insurance provider may offer you insurance, and that may be with exclusions and or loadings as well. So an exclusion is where an insurance provider may exclude you from claiming on a certain condition. So for example, if a client has previously had cancer, then the insurance provider may still offer an insurance policy to that person, but they may exclude cancer, which means that the client could not claim on that policy for cancer, but they could claim on that policy for other health conditions. And a loading is where the insurance provider agrees to insure the client, but for a higher premium, as the client may have a higher risk to a certain health condition. So such as when the client has a family health history of an inherited condition, such as diabetes, as this increases the client's chances of having this condition at some stage in the future. So insurance underwriting done up front means that when it comes to claim time, that you're more likely to have your insurance claim paid at a faster time. Some people see insurance as just an extra cost they can do without, so let's have a look at some statistics. So when you're young and healthy, it's actually not pleasant to think about, how that might change in the future. We don't like to think about aging, but the reality is that, accidents and illnesses can happen to anyone. And even a less serious diagnosis can have a major long-term effect on your family and your finances if it puts you out of work for a while. And that's why it's best to be financially prepared. The odds may be higher than you think. So in Australia, 50% of us will face a cancer diagnosis by the age of 85. That's the same for both men and women. And 1 in 5 people living with some form of disability, whether it be temporary or permanent. And in a single year, over 1 million Australians are diagnosed with heart disease, which is a leading cause of death nationally. So without being an alarmist, it's important to understand that these aren't just things that happen to other people, and that's why personal insurance does matter. So despite these risks, Australians continue to be massively underinsured, which is why we're bringing it to you today with some information. Many families not having enough cover to take care of their financial needs if something were to go wrong. So the median amount of life insurance held by Australians is just over $143,000, and the estimated amount of cover a young family actually needs is around $680,000. So by comparison, if you're getting your life insurance through super, like 70% of Australians, the typical default cover is around $200,000. And so that's why only 1 in 3 Australians have income protection, or what's more, 1 in 3 Australians have income protection insurance, which means that they could be left struggling financially if the household breadwinner is unable to work due to sickness or injury. So the end result is that if your family or yourself were to incur a death, illness or accident affecting your family, you may have to rely on Centrelink benefits, you may have to sell your home, you may have to sell other assets, dig into your savings. So it's not enough just to have insurance, you also need to make sure that you have the right type of protection too. So we'll have a look at the types of personal insurances. So it's really interesting that most people have home and contents insurance and car insurance as soon as they buy a home and a car, but they pay less attention to the personal insurance, or they may not know about the personal insurances. So personal insurances cover the things that have the greatest impact on your life. So your family, your ability to earn income, how would you pay for that car? How would you pay for that home if you were to be affected and unable to work? There are 4 main types of personal insurances: life insurance, total permanent disability or TPD insurance, trauma or recovery insurance, and IP or income protection insurance. So as well as the types of insurances, it's also important to know how the insurance works through super or outside of super. So while default life insurance through super can be an effective way to ensure that most of us working Australians have a degree of cover, it isn't a tailored product, and therefore you could find yourself uninsured. The insurance held through super, cost of the premiums would be taken from your superannuation balance, which will reduce your super balance, which in turn impacts the amount being invested, resulting in less money funding your retirement. So it's really good to weigh up whether you're better off to pay your insurance premiums through super or outside of super. So if we have a look at life insurance pays a lump sum to your beneficiaries if you pass away. It can also pay a lump sum to you if you're diagnosed with a terminal illness with some policies. Your loved ones can choose how to spend this money, whether it be to pay off debts, cover funeral costs, or invest in their future. And life insurance can be held personally, which means in your name, or it can be held in super funds. Total and permanent disability or TPD insurance provides a lump sum benefit if you're permanently unable to work due to a serious illness or injury, helping you cover the costs of medical care and ongoing living expenses. TPD insurance can be held personally or it can be held in super fund. And it's commonly linked to your life insurance policy to reduce the premiums. So this means that, for example, if you had $1 million of life and TPD insurance, and if you were to claim $500,000 of the TPD insurance, then you would have $500,000 of life insurance remaining. There are also TPD options available, which you can implement when beginning your TPD insurance, that can enable you to buy back your life insurance portion if you were to suffer a TPD event, or you can also have a double TPD insurance where you can buy back your TPD amount. But keeping in mind that these are options, they will cost more in premiums and they would need to be implemented at the beginning of the policy. So let's have a look at trauma, also known as recovery insurance. So that also pays a lump sum if you're diagnosed with a major medical condition. Each policy is different. They can cover things like cancer, stroke, heart attack, and you can also choose how to spend this lump sum benefit as well. So, for example, that might be on medical and rehabilitation services or alterations needed to your home, or it may cover your living costs if you're unable to work due to a trauma event. So trauma insurance can be held personally, cannot be held in your super fund. There is an option also to have trauma reinstatement when implementing your trauma insurance policy. So this would mean that if you were to claim on your trauma insurance, that your trauma insurance benefit could then be replenished for a future trauma claim of a different medical condition. There is also the option to have child trauma insurance linked to your trauma insurance policy, and this would cover the costs in case your child or children were diagnosed with a major medical condition. Income protection insurance, also known as IP insurance for short, provides you regular payments if you're unable to work because of an illness or injury. This is a monthly benefit that can be up to 70% of your income, enabling you to support your family, and that will cover your living expenses and possibly mortgage payments. Excuse me. The IP insurance will also have a benefit period and a waiting period, which can also alter your insurance premiums. So, for example, the benefit period is the time that your IP insurance would be paid to you if you were to make a claim. So some common benefit periods are 2 years, 5 years, or to age 65. And the waiting period is the time that you would need to wait from when you claim on your IP insurance until you receive your IP insurance benefits. So some common waiting periods are 30 days, 60 days, and 90 days. So to put this into an example, if you had a 30-day waiting period and a 2-year benefit period on your IP insurance, and if you needed to make a claim, then you would need to wait that 30 days for your first IP monthly benefit to be paid to you. And this IP monthly benefit would be paid to you for the 2 years. IP insurance can be held personally or it can be held in your super. So as you move from one stage of life to the next, you face different types of risks, which means that the types of cover you need can change. So in the early years of your adult life, you're just starting out in your career, you have fewer financial commitments. So this could also be a good time to implement your personal insurances as you're likely to be in good health. In the next stage of your life, you might get married, have children, buy a home. You're probably juggling your work commitments with the financial responsibilities of supporting your family and paying off a mortgage. So during this life stage, your need for personal insurances are often higher, as you want your loved ones to be fully protected in case something happens to you. And after your children leave home, the financial squeeze eases. You may be focused on growing your wealth, paying off your mortgage, and entering retirement debt-free. As you approach retirement age, your health risks can increase, making personal insurance cover quite necessary, since any period of time that you have off work can make a significant difference to your retirement savings. And once you retire and no longer need an income to protect, your financial focus may shift to preserving your wealth to fund your retirement. And with the potential increase of medical needs, it makes sense to make your personal insurance and your health becoming a priority. So how much insurance cover do you need? This is a great question, and it will vary for each person. So let's have a look at some points to consider when looking at this question. So this is an all-important question that many Australians struggle to answer when looking to protect their family's financial future. Putting a price on your life is no easy task, and the reality is that the right amount of insurance varies depending on your personal circumstances and also the state of your finances. So it's a hard question, but if you were to pass away, have a think about what your family would need to keep their current lifestyle. Or would your family need to change their lifestyle if you were to not be here any longer? Do you have a mortgage on your family home that you would like to have paid off through life insurance if you were to pass away? Would you like your family to have some funds set aside so that your spouse would not need to work for a while and may need to look after children? Another important fact to consider is, do you have school fees, and would you like that covered so that your children could remain at the same school? And also, how would your family pay for your funeral? If you were to be diagnosed with a terminal illness, what would the amount be that could mean that you could spend your final time with your family? If you had a trauma event, what would your spouse also need time off work as well as yourself to look after you? You may both be unable to work, and you may both need to take time off work to look after your children and your home. So a great way to start this assessment of your insurance needs and what you currently have in the way of your assets, and what you could sell or what you would want to sell if you needed to sell the assets. What income would your household still be receiving if something were to happen to you? So in considering income, consider all the sources of income that your family members may be entitled to if you weren't around. Current savings, family home, would you downsize? Do you have any investments, shares, property that could be sold? And also look at sources of income that you may be entitled to with a TPD or trauma claim, or family members may be entitled to after you're gone, such as employer benefits, so annual leave, any long service leave, income protection insurance, investment income and superannuation. You can interlink all of your insurances. You don't necessarily need to have, a life insurance and that's it. You can have all the four. You can have life insurance, TPD insurance, income protection insurance, and trauma insurance. If you were to have a trauma claim, you may, claim a lump sum from your trauma insurance policy, but you may not be able to work. So you may also claim on your income protection policy and get monthly payments from that as well. Then you need to look at the debts that your family would still need to pay in the event that you were to pass away, suffer an illness or an accident, and you're unable to work. So each year, families are left devastated, not only by the loss of the loved one, but also the debt that they must cover following the loved one's passing. So this is really important to have a think about it. I know we don't like to think about it, but it is really important to have a think about it and determine an appropriate amount of cover that you would need to take into account any debts that you owe. That might be mortgage debt, and that's not restricted to your current home. You may have investment property debt, or holiday home debt. Do you have any outstanding loans? This may be personal loans, investment loans, business loans, car loans. Do you have any existing credit products? So take into consideration any money owing on credit cards or interest-free cards or store transactions. And then you need to consider if your family would pay out these debts by way of using the personal insurance claim if something were to happen to you, or would they sell an asset to cover these debts if something were to happen to you? So future expenditure, these are very different for each individual, and your personal insurance needs will depend on your current situation, and you may like to have some or all of the following expenses covered by your insurance. These could be your annual living costs, which includes your food, clothing, bills, fuel, education costs for your children. That might be private, public, extracurricular activities like their sports, other planned expenditure, annual holidays, renovations, future investments. So consider the property or any other investments that you may have. Would you want your surviving family members to maintain these if you were to pass away, or would you want to retain them if you were to suffer a TPD or a trauma event? Also, a really important one is the homemaker duties. So consider how much it would cost to cover the unpaid duties that you regularly carry out throughout the home. So the cost of, your home maintenance, your housekeeping, child minding, because this can be quite a shock. So let's have a look at the stepped and level insurance premiums. So insurance providers will generally offer you the choice to have either level or stepped premiums. Some may offer a combination on policies. So the type of insurance premium structure you choose will affect the initial cost as well as the total cover over the life of the policy. You have a choice when it comes to paying insurance premiums between the stepped and level. So what does that mean, and how do you know which one is right for you? So there's not one size fits all answer, and it will depend on your individual circumstances. So we aim to lay out for you today the benefits and the drawbacks to the stepped and the level insurance premiums to make it less complicated, giving you better choice in protecting yourselves and your loved ones. So as the name suggests, stepped premiums start off at a cheaper point and rise from there. So premiums are recalculated each year with your birthday and increase. So in the short term, your insurance premiums on stepped may be cheaper, but as you age, they will increase by chunks. So one drawback to stepped premiums is the inability to accurately predict and properly plan for the increasing premiums. So if you do have stepped premiums, it's often good to look ahead and think about the bigger picture, the long term. Will you have the funds required for the higher premiums as you go into your pre-retirement and retirement years? Level premiums. So initially they cost more than the stepped premiums, but they don't increase as much with age like the stepped premiums do. So the level premiums generally increase with the CPI index each year. So while they're higher in the earlier years, they're more likely to remain affordable in the long term because you have more ease of predicting the level insurance premiums. So if you are looking for, in your situation, a more longer term insurance, then a level premiums may save you money in the long term. So the key differences between the stepped and level premiums, I guess the stepped premiums are kind of like a variable mortgage. The level premiums are kind of like a fixed mortgage. So if you're looking for insurance of more of a shorter term, then the stepped premiums may be more suitable for you. However, if you're thinking about estate planning and having long-term insurance in place, then the level premiums may be suitable to you. So let's have a look at the tax deductibility of personal insurance premiums. So life and TPD insurance held in and owned by your super fund are tax deductible to your super fund. Trauma insurance, unfortunately, is not tax deductible. And income protection insurance is tax deductible to your personal name if the policy is held and owned by you, and is also tax deductible to your super fund if owned and held by your super fund. So if you are a business owner, it would be worth you considering business insurance alongside your personal insurances. So when you're self-employed, you don't think twice about insuring business assets such as premises, stock, plant and equipment. But what about the most critical elements of your business, yourself and your financial commitments? So business owners often have unique risks that might not be adequately covered by their personal insurance. Business insurance can be used to protect against the loss of a key person and the possible resulting drop in revenue, as well as provide the ability to repay debts and protect assets from creditors. It can also be used to fund a business succession agreement in the event an owner of a business needs to sell their share as a result of a permanent disability or passing away. So there are four main types of business insurance: buy-sell insurance, key person capital insurance, key person revenue insurance, and business expenses insurance. So buy-sell insurance, that's designed to manage the risk to the business if a business owner is forced to exit due to illness, injury, or passing away. So the buy-sell insurance pays a lump sum that ensures the remaining owners can acquire the departing owner's equity and continue to run the business. It also enables the agreed compensation for the share held by the departing owner or their estate. The risks that can be covered by the buy-sell insurance are death of a partner through life insurance, total and permanent disability insurance, and trauma insurance. So alongside this, a buy-sell agreement would be recommended, sometimes likened to that of a business will, as this will help minimise the risk, such as the remaining owners needing to sell the business or take out additional borrowings to pay out the departing owner or their estate. Assets being frozen due to legal issues created by the departing owner, their family or estate. A departing owner's family deciding to become an active business partner against the wishes of the continuing partners. The departing owner's spouse or family taking up their legal right to claim business profits without working in the business. Or a departing owner's spouse or estate selling their share to an unsatisfactory third party. So it's a really good idea to have this in place in case something were to happen. So key person insurance, that provides a cash injection to your business to help offset the reduction or loss in revenue following the death or incapacity of a key person or employee. So who is a key person? A key person is someone whose continued association with the business provides that business with a significant and direct economic gain. Does not have to be the owner, but it usually is for the smaller businesses. It can be a salesperson, technical expert, or a silent partner whose reputation, contacts, or specialised knowledge gives your business an advantage. So there are two main types of key person cover. One is key person capital insurance. So key person capital insurance provides an injection of funds to maintain the capital value of a business and ensure its ongoing survival after the loss of a key person through death, disability, or critical illness. And the other main type of key person cover is key person revenue insurance. So key person revenue insurance provides compensation to a business for the loss of an employee through death, disability, or critical illness, which may have an adverse effect on the profit and revenue of the business. Business expenses insurance means that the fixed expenses of your business will still be paid, even if you cannot work due to injury or illness. So these are some of the regular, normal operating expenses of your business that would be covered under this benefit. That may be accounting and audit fees, regular advertising costs, postage, printing, stationery, electricity, gas, heating, water, phone, cleaning costs, security costs, rent, property rates, taxes, membership fees, leasing costs of plant and equipment, bank charges and interest on business loans, business-related insurance premiums, but not the premiums for this policy. It may also cover salaries and other related costs such as payroll tax, super contributions, and net costs associated with employing a locum. So when you implement business expenses insurance, you can choose between a 14-day or a 30-day waiting period. That's similar to our IP insurance that we spoke about earlier. Business expenses insurance benefit is paid monthly. It's also similar to the IP insurance we spoke about earlier. So this means that if you were to claim on business expenses insurance, you would be claimed as a monthly benefit. So I would now like to welcome Shannon back to explain how a financial advisor can help you with your insurance and to answer your insurance questions.
Now, one thing we find with insurances, and I guess, you know, an alternative is, you know, I guess you see it on the phone, the TV, the advertisements to get the insurance. I guess, as talked about earlier by Bianca, is that when you are getting insurance through an advisor, it actually is a different insurance, I guess you could say, product than what you can get from a retail market perspective. And they are actually undertaking a lot of the underwriting upfront. So you know that you're going to be getting that situation. The other thing that we tend to do with clients is, my goal ultimately for clients is to end up with such wealth behind you that you're self-insured, that you actually don't need the insurance company to fill in that gap because you've built up your wealth. But when you're at different stages of your life, it's going to become critical that if something happened and you didn't have that insurance, like unfortunately that situation that we've faced recently with our client, if they didn't have the insurance, their life would be a very different situation. And I know in speaking with that client, they actually, I guess you could say, kind of forgot that they had the insurance. and we're starting to wonder whether they'd have to pull the kids out of the school that they were going to and things like that. So what we try and look at is not necessarily changing your insurance company every year, or maybe never, because ultimately you have to go through underwriting, but look, assessing what your needs are and adapting your insurance cover to how your personal situation is going. Insurance has to be balanced with the budget. So you might say that you'd love everything covered, and that means your actual cover is quite high. Your premium's going to be quite high. So there might be a happy medium where you say, okay, I'm happy to self-insure a bit because I don't want to pay a premium of over X certain amount. So really trying to work out, well, how much cover do you need? What do you want the insurance company to cover? And then really get a tailored strategy. The one thing that we do sometimes see where someone has gone to an insurance-only advisor who maybe doesn't understand all of their personal aspects or doesn't understand their business, and realize they've actually got other cover in the business, they've got buy-sell agreements, different things going on. So you need to kind of work with it all together and then try and work out, we like to go through the different premiums so that you actually understand, is it stepped or is it level? What's the excess? What exclusions do we have? So kind of looking at it more holistically. And then if you do unfortunately have to have a claim, working through that process to make it as smooth as possible. Yeah. Going on to the next one.
Yep. Sorry, it's just taking a moment.
Yeah. So other areas we can help as well, not just obviously on insurance, looking at tax and business advisory, asset protection, wills and estates, wills and getting your will correct, making sure we've got those binding death benefit nominations, bookkeeping, mortgage broking, finance. We're trying to have this, in a sense, a one-stop shop for you so that, you don't have to go and give your information and tell your story to 10 different other people. We're trying to have it so that we can do that internally and make life a lot easier for our clients. So we just keep adding on more services as that interest comes about, I guess you could say. Yeah, so we'll open it up now just to any questions. Let me see if I've got any questions. Does anyone have any questions? We must have answered. We do try and answer everything in that document. I don't see, there's no questions that have come through at this stage. So we'll move on. If anyone has any questions, and maybe some of those questions, I guess when it comes to insurance, often some of those questions might be quite personal, related to your situation. So feel free to reach out and Bianca can help you with any of those. If you need something better than Netflix on a Friday night because you've watched everything, do go to our YouTube channel. You can like and subscribe. You'll see this recording, but you'll also see other webinars that we've done in the past to be able to kind of give you some insight to different areas. And if there's anything you think you would like us to cover, feel free to let us know as well. Right, so thanks very much for joining us today. Thanks everyone for coming along. I commend you for turning up, because insurance, we try to make it exciting, but it probably isn't as exciting as we would like it to be. So thanks for spending the time with us, and enjoy the rest of your day. Thank you.